Lisa, what are your odds?
Well, Alex, we are seeing hopefully a avoidance of the recession in the near term, and it's really just based on the fact that we came into the year with pretty healthy consumer and corporate financial strength. That being said, as we look through the year, we also recognize that there are a lot of two-sided risk, as you have been talking about. Policy is tightening here with the Federal Reserve and with central banks globally, and we still have elevated inflationary pressures. And so, with that kind of backdrop, again, there is going to be a growth slowdown. And so, I think the bigger question becomes not just in the near term, but longer term, how that trajectory will be evolving. And with that, we are seeing a more cautious stance, even though, again, maybe in the near term, we believe that we're going to narrowly avert a recession here in the next few months.
Lisa, the dot plots, of course, looking to 3.4% by the end of the year. What does that do to those corporate balance sheets and to those household balance sheets? A level of 3.4% or thereabouts. How much of an erosion will that be to the strength of that cash that's on hand?
Well, as you know, the interest rate situation is definitely tightening, and that makes it more difficult for corporations to continue to manage their earnings and to manage their financial strength. We are seeing, however, when we look at the levels of financial strength indicators, that really the corporate sector is generally on fairly solid ground. And so, in our mind, it's probably more of a question of really their appetite for spending going forward with the business environment being less certain, as opposed to in the near term, any strong risks from severe corporate weakening.
Lisa, I get the whole idea that we might narrowly avoid a recession within the economy. For earnings, do we avoid an earnings recession? I'm trying to really figure out if all the bad news is finally baked in, or we have to really lower 2023 estimates, and that's not yet reflected.
Corporate earnings, as you point out, Alex, are also very key. And what we see here are the same pressures that we're seeing on the economic front, that while, again, we came into 2022 on pretty strong footing, they are facing a number of pressures, whether it's from waning demand as well as elevated price pressures. And we're seeing that really start to come through in terms of second quarter earnings results, where, again, we are seeing some weakening of the reports with more mixed reporting across the universe. And so we are carefully monitoring what happens with those earnings. Again, similar to what we see on the economic front, we are still seeing some continued ability to have resilience, but we want to watch that trajectory as we move forward.
So there is some still ability around that resilience then in that corporate space. Where are you finding pricing power, Lisa? Where are margins still holding up at this point?
Well, certainly that's been tough across the board, but we are seeing, for example, in the consumer discretionary sector, where despite many of the challenges that have been facing on the retail front, that those earnings actually are coming in better than expected. And so there are pockets, again, depending on the specific company and the industry, where there are some signs, again, that companies are managing to hold their own. But again, as we have quite a few earnings reports into this week and the following week, those will really begin to cement the picture to a greater degree.
So, Lisa, I feel the vibe I'm getting for you is sort of a cautiously optimistic one. What do you do then with stocks and bonds in that environment?
Overall, we are more defensive right now. Again, while in the near term, we see some of that underlying fundamental strength that we came into the year as preventing the worst case scenarios, we do recognize that there are many headwinds. And so we are modestly cautious, advising our clients to move all other things being equal away from equities and more to quality fixed income, where, again, historically, they've been able to hold up in times of market volatility.
Quality fix. Is there still value in that space, though, Lisa? That's a call we've heard from a number of our guests over the last few weeks, in fact, the last few months. Is there still value within the high end of fixed income when it comes to the quality within that space?
Well, to your point, with interest rates rising, that impacts not only equities, but also the fixed income front. But nonetheless, what we see on a relative basis is that when you look across asset classes, even though we may still have the headwinds of, again, increasing interest rates and tightening Fed policy on that fixed income market, we believe it makes sense to have relatively more within that sector right now, again, just to provide some ballast to portfolios.
And Lisa, as we kind of wind this up here, do you think that the markets are complacent about inflation now, or do you think that there's still an opportunity, a cheaper opportunity to hedge yourself?
Well, overall, what we see with the inflation front is, again, elevated price pressures. And while our base case is that over the next several months, that should generally begin to move downwards simply because of very tough base comparisons from last year, where, again, it's hard for those price pressures to continue at certain levels. We do see a level of uncertainty as to how quickly those will come down over time. So our belief right now is, again, just to recognize that in terms of more defensive positioning on your overall asset allocations and focusing on that stock bond mix as opposed to trying to manage outright other inflation hedges.